Thanks for coming or staying to listen to me talk about Lendingblock. I'm Steve Swain. I am the co-founder and CEO. I'm going to run through a little bit of a story about who we are and what we're doing, then questions at the end. So we are the first cross-chain lending platform for the crypto economy. Let's look at what that is and why we're doing what we're doing. So what our starting point for building Lendingblock was to recognize that the size of the crypto market has grown much quicker than the maturity. So what we have now is a fast-growing, but in still some ways very immature market. So if you look at the maturity of exchanges, I think we've all been through problems, no doubt, of trying to get coins in and out of exchanges. If you look at the maturity of the payment systems, you know that it's almost impossible to be able to spend cryptocurrencies in the way that you would like to. And it's very difficult, if not impossible, to be able to access financing or hedging services. So what we're trying to do as a business is to be part of the maturation of the services that allow investors and users of crypto assets to be able to access those assets in the same way and with the same simplicity and sophistication as is possible outside of the crypto economy. So my background was working for 15 years inside investment banking technology, and then working for another 5 years as a consulting partner, advising banks on technology strategy. And what we've seen is that the pace of the market has way outstripped the maturity of those supporting services. So we at Lendingblock are basically building the financing infrastructure for crypto assets. So let's look a little bit now at exactly what that means. So Lendingblock, we are an open exchange that allows borrowing and lending of crypto assets. So that means borrowers and lenders can make loans or take loans in crypto assets in a very simple and safe way. So this would allow any lender, any holder of a digital asset, so anybody who has a position, to be able to lend that asset out safely and simply and earn interest on it in the same way that a bank would pay you interest on money in an account. We think passively holding an asset, you should be able to generate a return on that because there's value. And somebody sort of explained this back to me very nicely earlier today. And they said, it's like having a house. And if you have a house, it can go up in value. But if it's empty, then it's not generating the maximum return. So if you could rent out the house, generate rental income, as well as see the house go up in value, that's a good deal as a lender. On the other side, we're looking at people who want to be able to borrow assets. So this is where my knowledge of sort of the institutional securities lending market really came into it. So what we want to be able to do is to support people who need to be able to borrow crypto assets. And that might be for hedging purposes, it might be for a trading strategy, or it might be to support working capital or investment. And a good example of that is somebody who, for example, has Bitcoin and wants to hold them, but would like to be able to invest Ethereum into a couple of projects. So using our platform as a borrower, it would allow you to use your Bitcoin as collateral, borrow Ethereum to invest into an ICO, for example, and then at the end of that investment, sell out of the ICO coin, repay the Ethereum loan and get their Bitcoin back. So in that scenario, they have benefited from the appreciation in price of Bitcoin, but they've also been able to leverage that into an investment elsewhere. So what we're trying to do is to basically bring two really important features to this. We want to make it really simple to use, and we want to make it transparent. So we think that the way that you do this should be as easy as using any other website or any other app. You shouldn't even know that there's Bitcoin or blockchain underneath. It should be really easy to use and simple. The other thing is that we clearly, as borrowers and lenders, want to make sure that the assets that we're lending are safe and secure. So we're doing that in a couple of ways. And I think primarily the important one is that we are working to become a regulated business based out of Gibraltar and regulated under the DLT framework in Gibraltar. So this means that we have to meet the highest standards as an organization in how we operate and how we run our business. We need to be completely transparent about the controls and systems, and we need to meet the expectations of regulators who are making sure that on behalf of the users of our platform and investors into our business, that we are doing things in a way that is above board and completely professional. The other thing that we need to do is to make sure that the assets that pass through our platform are secure. So it's not just about trust in us, it's about trust in our ability to look after the assets that come through our platform. So that really means that we need to make sure that we've got the highest levels of information security, cryptographic security around the assets. So how does Lendingblock work? There are basically two parts to this. We have an exchange, and this allows, just as an exchange allows you to buy or sell coins, we have an exchange which allows you to make offers to lend out your coins or requests to be able to borrow. So going back to our example, if somebody wanted to lend out Ethereum, what they would do is to go onto our platform, they would submit a lending offer saying that they wanted to lend out, let's say, 100 Ether, and they wanted to do so for 3 months, and they wanted a minimum of 5% interest. On the other side, we have borrowers who are able to access the market in the same way. So they say, I would like to be able to borrow 100 Ether, and I'm willing to put up collateral in the form of Bitcoin. And what our exchange does then is to match those two orders so that we have the borrowing appetite and the lending capacity matched. The second part of the platform is then the operational smart contract. So what happens after the match is made by the exchange is that we create an automated, codified version of that contract, and we as a platform make sure that those loan terms are executed using the smart contract to govern the compliance with the terms of the agreement. So that includes things like making sure that the collateral is locked up and managed appropriately. It includes making sure that the interest payments that come from the borrower are distributed to the lender or to the lenders. And it means that if the borrower runs into problems and is not able to make the payments that are due, either the interest payments or the repayment, that we intervene on the behalf of the borrowers and take control of the collateral that's been lodged to cover the shortfall that the borrower is not able to make. So two parts, the exchange and then post-exchange trade processing. So what does that look like in practice? If you've been to our booth out here, booth number 10, just down the corridor, you might have had the chance to see this. It works just like any other exchange. So we can see here, top left-hand corner, that we have a yield curve showing the borrowing rates and the lending rates that are on offer from, in this case, I think it's Ethereum. And we have below that a market depth chart showing how many people are willing to lend at what rate, or how many people are looking to borrow. And then we allow you very simply to be able to execute a loan in that market over here on the right-hand side by saying that I wish to borrow or lend, at what rate I'm willing to lend at, and for how long I'm looking to lend. So it is as simple as we can make it, but there's also a very sophisticated matching algorithm and technical infrastructure underneath this. We also make the same information available via APIs. So this allows other people to be able to build their own interfaces or to be able to integrate directly into the lending platform. That's it. That's what we're doing. We are in the process at the moment of getting our regulatory approval with the Gibraltar Financial Services Commission. We expect that will be done at the end of Q2 and will be ready to be launched and operational in early Q3. We are also in the process of running our ICO at the moment, so we literally opened that in the last 24 hours. All of the information about the ICO is on the website, but we're in the middle of our pre-sale at the moment, main sale happening at the end of March in a couple of weeks' time. So at that point I will stop talking, I will start listening to your questions, and hopefully I'll be able to give you good sensible answers as well. Sure.
Two questions.
Sure.
Will you only accept digital assets as collateral, or will you accept cash and traditional securities? And secondly, how will the collateral be custodied? Will it be custodied by you, or what's the arrangement?
Great. So the question was, we're using digital assets as collateral, and who has custody of those? So we act as a security trustee. So we create a specific wallet for the collateral for every contract, and we control that using our smart contract. So the contract basically has the right to execute using the keys. If, for example, the level of collateral falls below the collateral floor that we set, the process is then that our smart contract contacts the borrower, requires them to top up the level of collateral. If they don't, then we basically start to liquidate that collateral to cover any shortfall. So yeah, we as a platform control the keys to that collateral, which is why it's really important that we're regulated, that we're audited externally, and that people are able to trust us in that, which is why we've gone down the route of saying, let's be proactive about regulation, not just with the Financial Services Commission in Gibraltar, but we'll be doing the same thing with the FCA here in the UK, with the SEC in Europe and in other jurisdictions as well.
Sorry, just to understand again, will you be accepting cash collateral and securities as collateral? Because if you accept other crypto assets as collateral, then presumably they might be highly correlated. So how do you plan to address the problem?
No, so we're not accepting anything other than crypto assets as collateral. So no currencies, no commodities, no stocks, no bonds. And there's two reasons for that. One is it just makes it simpler for us to be able to operationalize. Second is that we think that more and more assets are going to come to crypto. So we're going to see stable coins that are essentially interchangeable for fiat. We're going to see bond and debt instruments issued on the blockchain. We're going to see securities issued on the blockchain. And we'll be able to support all of those, but we don't want to go down the route of saying, let's take what we're doing into the legacy world. We want to wait for the legacy world to migrate to us. And as we said, there's sort of 500 billion worth of assets, give or take, already. That's going to grow organically, but as we start to see other types of financial securities, stocks and bonds move towards the blockchain, that number is going to become much, much larger. Thanks. Any other questions? One here. Thanks.
Hi, in terms of the collateral you're talking about,
yeah.
If I wanted to borrow some money, borrow some digital currency, would the collateral that I need to put down be equal to or more than what I would like to take out?
Right, so the question was how much collateral is lodged. So we're basically replicating the securities lending model in capital markets, which means that the loans are always over-collateralized. So then it becomes not about the creditworthiness of the borrower, it becomes about effective management of how much collateral is secured. So if you're borrowing $100 worth of Ether, you've got more than $100 worth of collateral that's lodged. Okay, great. Any other questions? Okay, great. Thanks for your time. We're just down the hall here. Come and speak to us in person if you want to. And thank you very much.